Silver just fell off a cliff, from 83 down to 75 in one brutal move. And that wasn't random volatility. It was the exact technical and structural setup we've been talking about playing out on schedule. I'm OG John H., and this video is the aftermath breakdown of that crash, the SLV arbitrage, the Shanghai premium, and why this is financial warfare, not a normal pullback. Segment 1. I warned you isn't flex, it's tape reading. In the last setup, with silver trading around 82.83, I told you clearly, as long as price is living under key moving averages, paper price can still go lower. Then we got a full-blown 10% dump. Silver smashed from the low 80s down into the mid-70s in what felt like minutes. That's not magic, that's structure. Price was stuck under important resistance. Bulls had no clean control. One heavy wave of selling was enough to knock out every week-long stacked underneath. This channel is not about I told you so. It's about showing you that when you know which levels matter, these so-called surprises stop being surprises. Segment 2. 3.6 trillion erased in 90 minutes. Let's put numbers on what happened across markets. In around 90 minutes, the smash did this. Total market cap erased, about $3.6 trillion. Gold down roughly 3.7%, wiping out around $1.3 trillion in notional value. Silver down roughly 8-10%, knocking out around $400 billion. S&P 500 off by about 1%, roughly $620 billion gone. NASDAQ down more than 1.5%, around $600 billion knocked off. Crypto down around 3%, about $70 billion flushed. That's not one asset had a bad day. That's a cross-asset liquidation event. You don't vaporize that much value in 90 minutes by accident. Somebody decided to hit the system hard. Segment 3, SLV discount, how they smash price and grab metal. Now let's talk about one of the most important pieces almost nobody understands, the SLV discount trade. During the smash, SLV, the big silver ETF, started trading at a steep discount to the actual value of the silver it supposedly holds, its NAV. Here's how banks can use that. They hit silver futures and spot, smashing the price. SLV falls faster than the underlying metal, slipping to a discount. They step in and buy SLV shares cheap in the open market. They then redeem those shares with the ETF sponsor in exchange for physical silver. That physical is used to cover short positions on COMEX or elsewhere. End result, paper price gets hammered lower. Public holders of SLV panic and sell cheap. The same players who smashed the price walk away with real bars, not just paper. On the chart, it looks like silver is crashing. Nobody wants it. Under the hood, it looks like they engineered a crash to strip physical metal out of the system at a discount. That's what financial warfare looks like in 2026. Segment 4. Shanghai holiday smash. Same playbook every year. Now layer in the calendar. The Shanghai Metals Exchange is closing for Chinese New Year, closed from February 15th through February 23. 8 full days with the key Eastern physical market offline. Historically, what happens when Shanghai goes dark? Western banks suddenly have a clear runway. The big Eastern physical buyers are not actively bidding in real time. That's when the most aggressive paper selling and mysterious smashdowns tend to show up. So what did we just see? A violent silver dump right into the start of that window. Thin liquidity, scared sentiment, and no live Shanghai price to push back against the Western futures narrative. That's not random. That's playbook. Segment 5, CPI front-running, crash before the print. Now add one more timing layer, CPI. The big inflation print is due tomorrow. 90 minutes before, markets decide to erase $3.6 trillion in value. Ask yourself, did someone get a good read on what CPI is going to show? Or at least want to be positioned aggressively before the number hits? Here's how this kind of thing often plays out. If CPI comes in hot and metals bounce hard, guess who gets to buy that bounce cheaper? Because they smashed it the day before. If CPI comes in cool and markets roll over again, they're already short and can ride the risk-off move further. Either way, the smash before the print is not random. It's a way of front-running whatever narrative comes next. Segment 6, COMEX March, 3.3x paper trap still there. Now let's revisit the COMEX structure, because that did not go away with this crash. March open interest, about 65,000 contracts, that's 325 million ounces of paper silver, registered silver at COMEX, under 100 million ounces after a recent multi-million ounce withdrawal. That's a more than 3.1 ratio, over 3 ounces promised on paper for every 1 ounce actually sitting in the registered pile. February already gave us a preview. Deliveries demanded over 100% of the open interest in that month, something you almost never see in normal conditions. Now you see why veterans like James Turk are openly talking about a potential March silver squeeze. You cannot have delivery months where people consistently demand more metal than the open interest and more metal than you have registered without stress showing up somewhere. The 10% crash didn't fix this. If anything, it took pressure off temporarily, scared off weak longs, probably allowed some shorts to cover into panic. The underlying 3.3x paper trap is still there, waiting for first notice day. Segment 7, technicals 75, 74, and the 64 landmine short-term traders. This is your battlefield. Right now, after the smash, silver is hovering around $75. Key nearby support around $74. If $74 holds, the structure can start to form an inverse head and shoulders on the larger time frame. Left shoulder, Chalcha previous swing low. Head Socrates, the 63 tar 64 washout low. Right shoulder, Socrates, this current 74-75 zone. If that pattern completes and breaks up, it's a textbook bullish reversal setup. If $74 breaks decisively, the market can absolutely revisit that $64 region, the previous crash low. That would be the point where sentiment turns full doom and where value investors and physical stackers start licking their lips. Overlaying that with the 150 EMA on the hourly, price is still below that moving average. That EMA continues to act as a ceiling, not a floor, until silver reclaims that level with conviction. Technicals still allow another leg down. You respect that. You don't YOLO long just because it's already down a lot. Segment 8, physical market, $7 Shanghai premium and reality check. Now, while futures are doing circus tricks, what is the physical market saying? Current snapshot, Western spot silver around $75, Western futures around $76, Shanghai spot around $80, Shanghai futures around $85. That's a $7 premium in China, higher than the previous $6. Think about that. Paper price in New York and London just got nuked 10%. Real-world buyers of physical metal in Shanghai are now paying even more above that Western paper price than before. That is not what a dead market looks like. That is what a stressed, tight market looks like. When physical keeps saying, I'll pay more, and paper keeps saying, we insist it's worth less, you are watching a pricing system fracture in real time. Segment 9, fundamentals didn't change in 90 minutes. In that 90-minute wipeout, here's what did not change. We are still on track for the 6th consecutive year of silver deficits, with demand exceeding supply by around tens of millions of ounces, according to the Silver Institute. India is still set to import roughly a quarter of global mine supply in some estimates. COMEX still has a 3x plus paper to registered metal imbalance into a major delivery month. Shanghai is still in backwardation, meaning near-term silver is more expensive than silver for future delivery, a classic sign of tight inventory. Macro stress, from rising bankruptcies to consumer delinquencies to sovereign debt strain, did not magically vanish. What changed? Who is still in the trade? Who got rinsed out? Where the narrative tries to take your attention. The crash was in price, not in core thesis. Segment 10. How to play this if you're serious. So how does a serious silver investor or trader respond? You don't. Shrug and say, number go down, silver bad. Or blindly buy the dip with max leverage and no plan. You. Respect volatility. Silver can move 8-10% in a day. Your position size and leverage must be built with that in mind, or you will be forced out at the worst time. Separate time frames. Traders, you care about 74 support, 64 risk, 150 EMA reclaim. Investors, you care about deficits, COMEX structure, Shanghai premium, macro stress, and what that means 2 of 5 years out. Verify the mechanics. Look at SLV premium discount data. Pull COMEX registered versus open interest numbers. Track Shanghai premiums and backwardation when it reopens. Keep dry powder. This may not be the final low. In a market this manipulated, the best setups appear when everyone else has given up. Don't fight the tape blindly. Understand what game is being played and decide which side of it you want to be on. Closing. This is financial warfare, not normal trading. Silver didn't just have a bad day. It dropped 10%. Helped erase $3.6 trillion across markets, traded through an SLV discount that let big players grab physical, got smashed right before CPI and just as Shanghai heads into an 8-day blackout. That's not normal. That's strategy. You've been watching John AG here, and I'm OG John AG. If this helped you see the difference between noise and warfare, hit like so this kind of breakdown doesn't get buried. Smash subscribe and turn on all notifications. We're going to track CPI, Shanghai's reopening, and March COMEX delivery in real time. And drop a comment. Smash or setup? Tell me if you think this was just destruction or the setup for the next big move in silver, and why. Now before we wrap, let me be crystal clear. I will never ask you for your money. No courses, no VIP groups, no paid signals, no mentorships. If you ever see someone using my name trying to sell you anything, it's a scam. Report it immediately. This is financial warfare education, not financial advice. I'm not building a funnel, I'm building a legacy. You should always do your own research and talk to a licensed professional before you invest a single rupee, dollar, or ounce. And if you're actually learning something here, if you're verifying the data and it's sharpening your view, just drop a comment. OG John AG. 2 words. It tells me who's really paying attention, protecting their capital, and staying away from anyone promising easy money.